Run in and run in, run in and run in. Nike Inc. I think it used to be Nike Corporation, didn't it? A beautiful Oregon company. Nike needs no introduction. I mean, I think all over the world, people are putting on Nike shoes and feeling what this company is. Because this is such a relatively simple company, I want to take the opportunity to make this an over-explained video that's going to zoom out and talk about the structure of what I'm doing here when I'm going through these annual reports. Structure that will hopefully make these videos more fun to navigate, because all of my videos are designed to be navigated, watched and rewatched in whatever order you please, but also a structure that will allow you to increase your understanding and odds of success when looking at these annual reports on your own. Nike will also be the 6th company in the 2023 season, and so at the end of the video, we're going to ask Sage Seeds AI to rank this company in terms of value. That ranking will be very useful in contextualizing our 10K analysis, our annual report analysis. And while it's not investment advice on its own, I find it to be quite a critical part of my investment analysis process. So when looking at an annual report, the first thing we have to keep in mind is there are dozens and dozens, sometimes hundreds of pages. In the case of today's report, Nike has 99 pages, and this is on the short side. Often you're easily getting over 100 pages. That would be kind of crazy for anyone to just read through from page 1 to the end. Instead, what we're going to do is we're going to have an opening move. And my opening move that I prefer is to go to the item 8, which has 2 sections, the financial statements and the supplementary data. I go to the beginning of the item 8. I go to the financial statements. And these financial statements I refer to as the numbers. Now, why do I treat this as my opening move? Well, because in my experiences, these financial statements are the most standardized part of the entire annual report, because there are actual legal rules that they have to follow and to adhere to generally accepted accounting principles in these financial statements. That's where I have the highest chance of having background knowledge to be able to interpret effectively. If you just learn how to get through these financial statements, you'll have the best shot of understanding this massive document by starting there first. It'll be a place where you get to practice, basically. After the opening move, we really are looking for changes in the business. There's always so much going on that trying to understand everything about a company or business is not the right way to analyze a 10K, in my opinion. Instead, what you want to do is you want to zero in on what are trends that are changing. Is a strategy changing somehow? And once you identify that, you want to use that as a filter in order to turn these 99 or whatever pages into a much more manageable amount. We basically want to selectively filter out as much of this document as possible just by focusing on the things that are clearly changing in the last year or 2 years. So after the opening move lets us kind of have a theory about what is changing in the business, we're going to transition to gathering facts. And when we gather facts, we will be going to almost always the supplementary data of the item 8. These are notes prepared by the Chief Financial Office about things that they think are important in the financial statements. And then from there, we will bounce around as needed, depending on what becomes interesting. One of the more common things that we find is we go to the item 1, and they always have a business section which describes their business to potential and existing investors in the item 1. That often shows up. Everything else in the item 1 is going to be specific to the company preparing the report. The item 1 is prepared by the investor relations department of the business. So in the case of Nike, this is quite beautiful, actually, quite professional. It's not always this clean. Sometimes we look at either the properties or legal proceedings, depending on the type of business. Similarly, sometimes we look at the controls and procedures and disagreements with accounting firms, if any of that comes into play. Finally, a common place that we look is the item 7, which is similar to the notes to the financial statements that we saw in item 8, but item 7 is notes provided by the CEO's office and by management. And so oftentimes this is more people, more extroverted people, more business type people. They have their own opinions and analysis of what's happening as well. That's kind of all of the options that we have. We do not usually go to all of them. We usually go to 1 or 2, depending on what we saw in the opening move. After we've gathered facts, I will transition to unraveling the story behind the numbers. What's great is that even the most complicated businesses typically aren't changing in more than just a handful of ways, and so we can get a really solid story for the year of this annual report. At the end, I'm also going to call in the Sage Seeds AI, which is a collection of really value investor type calculations coming together using artificial intelligence in order to give us some insight into how to think about the financial situation of the business with a nice helpful ranking. It's just a nice final way to solidify everything that we learned, the story that we learned, with the background of the numbers do matter. The AI gives us a hugely and helpfully simplified version of the numbers. Okay, with all that structure in mind, let's dive in so that your wisdom can blossom. Going to the item 8, the auditors wrote their note. It looked like they were having a couple of small problems with income taxes and all this other stuff, but we'll go back if it becomes interesting to the story. Otherwise, we're now at the financial statements, and the very first one in this case is going to be the statement of income. I'm not going to over-explain how to read these financial statements in this video, but if you do want more information about how to look about the details of a statement of income versus a cash flow versus a balance sheet, keep a lookout for future over-explained videos where I will dive into specific financial statements. So in the statement of income, we can see stable growth, something called demand creation expense, which a lot of businesses would just call sales and marketing. Businesses growing stably. Net income was lower largely due to an increase in income tax, but it's not bad to pay your taxes. It's fine. Continuing now to the balance sheet. This row here, short-term investments, we've been seeing it over and over and over again over the last couple of years. Companies used to not do this. They are counting it as cash-like, and so instead of just having cash, Nike has billions of dollars in cash and short-term investments, and they're assuming that they can use these short-term investments as if it were cash. It is what it is. Almost all companies are doing it. Inventories is pretty stable, which is good to see. The total assets compared to total liabilities is a ratio of about 1.5, close to the ideal for a retail business. For a retail business, 1.5 would actually be the ideal because retail businesses often have to have a fairly balanced situation between assets and liabilities. I mean, Nike is just nailing it spot on. I mean, this is literally the ideal situation in theory. Great job. Finally, the statement of cash flows. Depreciation, very reasonable for this. In fact, it might be even kind of low for this, which is a plus. This is kind of implying this low depreciation relative to how much sales they have is implying that Nike is using internet sales quite well, and that basically all the storefronts that they have, they're being quite efficient in using that storefront real estate in order to generate sales. For retail companies, a lot of what matters in the cash flow statement are changes in working capital, which are all of these rows. Everything seems pretty standard and steady in the working capital management. Their changes in inventories have not really slowed down at all. Many companies did change up their inventory management strategy post-pandemic. In particular, the Dollar General video, which came out not too long ago. Dollar General is an example, and in that video we get pretty deep into a company dramatically changing its inventory management in relation to macroeconomic situations and really the effects of the pandemic lockdowns. Here, Nike doesn't seem to have noticed any difference. They're just chugging along, which is great. These purchases of short-term investments have actually been in over $10 billion some years in the last recent years. The main thing standing out to me in this cash flow statement is billions and billions and billions of dollars being put into short-term investments. Nike is not a financial services company. So all the businesses out there are dabbling in owning financial assets, even if they have nothing to do with financial services. This is, quite significant. It's the most significant thing on the cash flow that I'm seeing. And what you really have to ask is, banks and financial services companies put billions of dollars into short-term investments because they have the infrastructure and the finance people in order to monitor these investments and, more importantly, to calculate the risk of these investments. Is Nike managing the infrastructure? Are they scaling up some sort of risk management infrastructure in order to be supporting these billions and billions of dollars in short-term investments? Even if they are scaling up, the question remains, why is this company focusing on managing financial assets instead of, making shoes. And honestly, we've been seeing it all over the place. I think this is the first time we're seeing such a large, stable company that actually allows us to dig deep into this question. It's actually about time that we take just a case study in what is a company thinking when they're doing this. We're really looking for anything that can allow us to expand on the observation we made in the opening move. We know that one change that the business is going through is an increased focus on short-term investments. And so let's see if any of these notes speak to that. My eye is going to note 4, fair value measurements. All right, so let's go to note 4, fair value measurements. They are giving us a table of all of their short-term investments. And so cash here for the latest year is at around 1.7 billion. That is just straight up cash that they have in their checking account. They then break up the rest of what they're calling cash equivalents into different levels. Most of it, over 5 billion, so the substantial lion's share, is in things called money market funds. Now, these money market funds are actually the same thing as the other things here, but it's managed by a money market asset manager. This line, commercial paper and bonds, this is debt in other companies, probably companies not even that dissimilar to Nike, but this is debt from other companies. That's what we mean by commercial paper. But this about $500 million that they have in it has to be managed by Nike. And so they have to have finance people within Nike to keep track of this debt that they're purchasing instead of just having cash. 10 times more of the money that they are investing in this, quote unquote investing, you don't have to have finance people to manage, because when you buy a fund, a money market fund, you are buying the asset managers and their finance people are going to be keeping track of everything that's going on. How can Nike have billions and billions of dollars put into short-term investments without having the infrastructure that a financial services company would need to do the similar things? They're actually outsourcing the management of almost all of it. I've actually control F'd for the word short-term, and this has popped us over to the item 7, which remember is the CEO's office or management's discussion of the business. They have a section called liquidity and capital resources, and the first subsection is called cash flow activity. Nike makes around a little more than 6 billion. 90% of it roughly is returned to investors. Whatever is left is largely being devoted to these short-term investment shenanigans, I'm going to call them. Now, they're quite serious. They're not actually shenanigans, but I'm going to call them shenanigans. Nike's business has been the last year is make billions of dollars of the great business, return money to investors, give money to money market fund managers. At this stage, I think we're ready to transition from gathering facts to unraveling the story. And to get that started, I'm going to present the argument for why back in the day, companies like Nike, companies like shoe stores, never spent so much time and effort managing financial investments. Then I'm going to present the counter argument very strictly. If Nike is making billions of dollars, don't invest that for me. Give me back the money that the business is generating. And if I want to invest in money market funds, I don't need you to be a middleman. I can do that myself after you've given the dividend. If I wanted to invest in money market funds, I could do that on my own. As an investor in Nike, all the money that's being given to money market fund managers is essentially being held hostage. And there's an opportunity cost now that I have to worry about as an investor. Now, if I give my money to a shoe company, they might essentially go somewhat rogue, stop using my money to make shoes, and start using my money to invest in all sorts of assets that were not really what I was focused on when I found the shoe company. Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. I would like to be able to invest in just a shoe company. Don't love that there's now this second layer of finances being attached to what was a pretty good business in the first place. This opportunity cost really is a willful transition on behalf of Nike's management. Instead of them having an opportunity cost, now their investors have to calculate the opportunity cost. And it's not very nice to investors, but I can very much understand why they're doing it. The counter argument, why is this something that Nike wants to do? The fact that they don't have anything to do with these billions of dollars right now, but if an opportunity comes up, they want to have the flexibility to take advantage of it right away. What would happen if they just kept $10 billion, which is roughly what we're talking about here, in cash? Investors would as they historically have done, immediately start complaining. They'd say, why do you need so much money in cash? Why don't you just give it back to us? Just give us a special dividend. Give us a special dividend, blah, blah, blah. That happens over and over and over again. Nike doesn't want to deal with that, probably. They can lessen that by having a bit of a shield, right? This is really what they're purchasing when they give money to money market fund managers. They will be earning more than if it were just in a checking account. Let us have that money available for potential opportunities. It's doing just enough to count as something. Let's put this into some historical context, because it used to be that companies didn't buy short-term investments at all unless they were financial services companies. In that world, there were still the potential for opportunities, but what did it look like? Well, it would look like if Nike makes $10 billion, they would return $10 billion to investors if there is no better use of that capital that year. Then, if a couple months later, an opportunity arrives and they say, oh, that money we gave back to investors, now we know what to do with it. Well, back in the day, they would then call an investment bank and say, help us re-raise money. And this is classically how you get investors provide money for businesses to use when there are opportunities. Nike is cutting out the investment bankers, cutting out the need for multiple rounds of funding, or basically to fund opportunities as they come up. They want to use their past success in order to keep the money in their control so that if future opportunities come up, basically they don't have to call investment bankers. And I can't lie, it makes a lot of sense. I understand why Nike would do this, but also let me remind you, it's not just Nike, it's pretty much almost every company under the sun is increasingly doing this. And it's because people don't like working with investment bankers. Let's just say what it is. Back in the heyday of investment banking, the 80s and 90s, investment bankers were far more used and charged way less. As they've been less used, they've raised their prices, and it's been a continuous raising of prices. The management of this company, I'm sure, is very happy if they can avoid having to work with investment bankers to raise funding for opportunities. And they don't mind that they're being a bit mean to investors in this specific scenario, as long as it means that they get to very much guarantee they won't have to call investment bankers for the foreseeable future. Since the price of investment bankers has increased so much, they're replacing that financial service with the financial service of these money market asset managers. It's not an exaggeration to say that the price of a money market fund is easily 1/100th the price of what it would cost to have a round of funding if an opportunity were to arise. In some cases, it could even be as much as 1,000th the price. I mean, it's just a huge discrepancy in the expense. Arguably, Nike might be doing some internal calculations and thinking, this is how likely we think it is that we'll be able to use this money in an opportunity in the future. We're actually saving investors money if we avoid paying super high investment banking fees. I'm sure it's at least someone in the business is thinking that. All these companies that do this have essentially become middlemen for me. And as an investor, I now have to be, are you a shoe company that's going to give me my money back once it works? It's become perilous more than ever to be an investor, because not only do you have to find investments and opportunities to invest that make sense and that will generate money, but now you have to figure out if money is generated, which is already a huge hurdle, am I even going to get this money back, or is it just going to be locked up in a money market fund that I don't get to touch? Going back to the over-explanation topic, we're now going to go and ask the Sage Seeds AI and to rank this company, this business, according to valuation. A rank closer to 1 is going to mean that the AI is seeing more financial value, where a low ranking would really indicate you could probably find better alternatives out there with current market prices. Now, all the market prices will be up to date as to when I am making this video, and so this is definitely not investment advice, but I find it remarkably useful to have value investor wisdom distilled to the output of an AI. Please like, subscribe. Talk to us about any recent Nike purchases. I mean, I know the tiers of Nike purchases can really get quite up there, but I would consider really any Nike shoe to be kind of fancy. I've been climbing up the tiers myself. Got some Giannis Antetokounmpo shoes a couple years back. On overstock, yes, but you know, value. Share your experiences in the comments, share your wisdom, share this video. Nike is ranked 1 out of 6 in value for the 2023 season. And so another company taking that first place spot. I will say though that compared to the Dollar General video where it was very, very neck and neck, Nike here is comfortably taking the number 1 spot. The AI is really giving a lot of credit to the fact that Nike is highly profitable, and every year, year after year after year, they're able to achieve quite high returns. The topic of this video, while it is all accurate, we can put into context that if even in the worst case, a lot of value just disappeared from their short-term investments, which would be awful, Nike would replenish that cash in a year easily with their core business. And so everything they're doing is very measured. It's not unreasonable by any means. And the AI is really not bothered by that opportunity cost that they're shifting onto investors. It's more focused on the core underlying business, which, fair enough, is huge.